Hello, it's Jonathan Wellum of Rocklinc Investment Partners, and it's that time again for our webcast. And so we're looking forward to updating our investors on the last quarter and some of the things that we're looking for going forward. So let me just begin with a quick outline of our presentation. Again, just a few words in terms of Rocklinc, an overview in our history, our investment principles and philosophy and process, along with some of the investment challenges that we're looking at in the current environment. We'll spend a little bit of time there this morning. We'll just remind you of some of the sectors of focus where we have a large portion of our assets invested in. And then I'll give a quick performance summary. And then I'm going to hand it over to Jesse Vandermeer, who will talk about gold and sort of the case for gold and why we have a number of investments in that space. And then Andrew Cheng's going to finish up with a look at one of our longer term holdings for many of our clients, and that's Nestle, which falls into the consumer staples space. So let's get right into it now. In terms of a quick overview, we're getting close to our 12th year now in terms of Rocklinc. We're pushing over 240 million in terms of assets under management, over 200 families. So we're very thankful for the growth over the last couple of years in particular, some solid growth. And we now have 6 full-time employees, and we're looking at adding to our ranks. So we're very excited with the progress in terms of the business. Our Rocklinc team, just to give you a quick org chart there, if you're reaching out to us, you can obviously talk to any one of us, but just if you note the folks in that org chart, then you can reach out. Like, for example, if you're looking for someone in administration, you can talk to Doretta or Braden. In portfolio management, Jesse, Andrew, myself, and also my son, if it's in sort of marketing and some of the admin areas also. So anyway, that just to give you a quick overview in terms of the folks in the organization. Our corporate partners, we always put this up. We're very proud of our corporate partners and those that we work closely with and are very important to our business. And so we'll just let you look at that at your leisure. In terms of our investment philosophy, I always like to go over this again to remind our investors of just how we go about investing. So I apologize if we do this every time, but I think it's so critical that you understand our philosophy. First of all, we're looking for safe assets. We run focused portfolios. We do not want to be all over the map and diversified in every direction. We want to have a focused portfolio. Medium to longer term holding periods, and so we are trying to find businesses that will compound and that businesses we can stay with for reasonably long periods of time and compound on a tax deferred basis. We're very careful about the prices we pay, purchase at a margin of safety. I'll be talking a little bit about prices in part of my presentation here this morning, and I'll fill you in on that in terms of what we're seeing in terms of prices and how expensive things are in the market. Understand the current economic environment. Again, I'll be addressing some of those issues in a few moments. And we always use an ethical overlay. We're very concerned about the principles and the values of the companies that we're investing in. In terms of the investment process, we stay within our circle of competence. We try to think independently, evaluate risk factors, look for industries with above average growth, invest in businesses with high returns on capital. In particular, we look for businesses with high operating leverage. That means that they just become more and more profitable as they grow. More and more of the money drops to bottom line. Margins continue to increase. And we prefer simple businesses over complex businesses. We've found certainly over the years that businesses that are hard to understand or very complex can often get you into trouble. And so we like to stick to businesses that we understand very well. Investment challenges. I've listed 5 here. Some of these we've talked about before. Some are new ones that I want to mention that I think are important ones to have on your radar screen and to be attuned to in terms of risks both now and in the future. First of all, the levels of the deficits we've seen over the last couple of, really last year and a half in particular with COVID, the debt, the accumulated debt, and all of the money printing that's gone on. Believe it or not, the global economy has added $36 trillion US of new debt in the last 18 months. That's on a base of about 85 trillion global economy. So you're thinking 40% of the total value of all of the global economy we've added now in debt in the last 18 months. It's really a staggering number. And so we need to be concerned about that and how it impacts our investments. Global geopolitical instability. I'll talk briefly about that. We'll also talk, again, briefly about this cult of ESG, this preoccupation. If you're reading the papers, you probably are reading more and more about ESG, which stands for environmental, social, and governance issues. It's become sort of the virtue signaling expression of the age. And I'll make a couple of comments about that. COVID-19. Have to talk about COVID-19. The virus that just won't go away. And I'm going to just mention a couple of things that we're keeping on our radar screen in terms of vaccinations and vaccine passports. And then just briefly look at market valuations. So let's get into it. The levels of debt and the deficits are just off the charts. I mean, these are levels I would never have expected to have seen. This chart that's in front of you right now just looks at the situation in Canada. And you might have seen this. It's been floating around on the internet. It basically shows that under the leadership of Justin Trudeau, we have expanded our debt to the tune, like if you take Trudeau's expansion of debt over his tenure since 2015, in particular, most of this would have been racked up in the last year and a half. He's added more debt than all of the debt that the previous prime ministers had aggregated or accumulated. So we basically have doubled our national debt at the federal level. It's quite a staggering number. And hopefully you bear that in mind when you go to the polls in the next few days. Hint, hint, and in terms of who you're going to be voting for. Hopefully not Justin Trudeau. But you all know, my clients all know where we stand on political issues. The next slide just shows you globally the level of debt, something that I already made reference to, the 36 trillion added global debt over the last 18 months. And what you see here is, you can see that large uptick if you're looking at the far right-hand corner in the upper quadrant there. And you can see that global debt is almost $300 trillion. That includes, government debt, personal debt, corporate debt, and so forth. And if you look at that chart since 2014, we've seen debt, basically jump about $80 trillion in about 6-7 years. Debt is growing at a much, much faster rate, 2 to 3 times what the growth rate is in the economy. This is not sustainable. This is something that we need to be very, very careful about. And this last slide, which I apologize, quite small, and if you look at this, if you want to understand this, it lists countries, I should say, on the far left, and then on the right, it gives you the percentage increase from the zero base. So all of it is measured off of a zero base, and it gives you the percentage of debt as a percent of the GDP. So the level of debt as a percentage of GDP increase over the period of COVID, which would be, say, the last 18 months. And you can see in some cases, if you look at France and Canada, UK, some of these countries have increased their debt by 50 and 50 plus, almost 60% debt to GDP. Canada, we're over 40%. We're very high up there. And so what it's showing here is right across the world, there's just been this massive debt binge. And I don't have the time to talk about it in this particular webcast, but most of this has been funded by the printing of money, just digitizing money, putting it out there. And that's one of the reasons why you'll also be seeing quite a bit of inflation as we pump more money into the system. Housing prices have gone up, food prices have gone up, and this is going to be a problem that we're watching very closely. The second issue, just quickly, global geopolitical instability. I don't think I have to tell you that when the U.S. is weak, and we've seen the U.S. weakness, particularly since the new administration has taken over, we've seen a large uptick in global instability from a geopolitical perspective. This has reached a peak with the horrific exodus, if you will, of the U.S. from Afghanistan. And so now we've got China, Russia, Iran, now Afghanistan, aligning themselves. This clearly means an increased threat of global terrorism. That could be, physical terrorism. It could be cybersecurity. These are risks that we want to be aware of and also factor into our risk profile when we are investing. It also, we're seeing around the world this sort of move to the left politically, and this is leading to an increase in global regulations. And whenever you are regulating more things, it leads to lower economic growth. And so this, again, is going to put pressure on companies. And with all of this debt, we're seeing this insatiable demand for new tax revenues. And so governments are coming up with all sorts of interesting ways to grab more money, take more money out of our pockets. And that's not just in Canada, and we'll see what happens after the next election, but also in the United States and Europe and so on. And so this demand for more taxes to prop up government spending is alive and well. In the United States, for example, which would impact the Fortune 500 companies, the big companies on the S&P 500, we're seeing the pressure to put corporate taxes up from 21% to 26.5%. If that happens, that means less earnings, that means pressure on valuations on stocks, so it's something that we want to watch. The third issue, the cult of ESG, environmental social governance. I'm just going to really just say a couple things about this and not go into a lot of detail, but just to point out that as you're reading the papers and you're reading about ESG, there's so much virtue signaling here. And people are just, there's a herd mentality. Everybody just sort of follows everybody and they all talk about ESG. We as a company are very concerned about the environment. We're concerned about social issues. We're concerned about governance issues. That all investment professionals should be thinking along those lines, and I dare say that they are. But this is a term that's been picked up, and now everybody's running with it as if somehow it's this novel concept that we never thought about these things before. And I think we need to just stand back a little bit and think about this. If you are going to just pump money, for example, into things that are green, everything green, without doing this in a proper timeline and thinking about how you're going to do it and the best ways to do it, you just throw money into it, is what we're seeing by governments around the world. This is going to lead to a misallocation of capital. It means there's going to be lower rates of return. So as we're looking at industries that are in the green space, and that's great, there's some wonderful businesses in that space. We own companies like Brookfield Renewable, TransAlta Renewable, and Northland Power. They all have different parts of the business that are involved in renewable energy. We want to make sure these companies, again, are able to make the kind of returns that they should be making, and they're focused on market rates of return, not being subsidized by the government and misallocating capital, and this is a problem. The next issue I just mentioned briefly, and you've probably heard more and more about this, is this sort of dangerous and divisive theories that are being promoted in the social context. I mentioned here CRT, that's critical race theory, cultural Marxism, standpoint epistemology. These are all theories that take us further away from working together as a unified society and breaking us into little groups, into ethnic groups, into how we view human sexuality, different economic statuses. And they break us all up into little pieces, and they get us all sort of fighting with each other. And they talk about oppressed groups here and oppressed groups there and so forth. Well, the more that gets embedded in our society and in our economics, it just builds division, it builds animosity, it builds tension, it builds public policies that are dangerous to economic strength and free markets. And so we're watching this development as this filters through our school systems into corporate boardrooms in very dangerous ways, and it really attacks the foundation of our society. And I think these are very dangerous ideas, to say the least, and I really can't overemphasize this. And so we're keeping a close watch on these ideas to make sure that we're incorporating these into our thought process. The other issue that I want to mention right at the end is all this issue about governance, corporate governance. And you probably hear this quite often if you're reading the papers. You read about diversity and equity and inclusion and so forth. And of course, these are all wonderful terms. It depends on what you're doing with these terms. If you are actually promoting people who are not qualified, if you're putting a preoccupation on skin color or one's human sexuality and so forth, and you're not valuing the person as a human being made in the image of God and valuing all people equally, then again, it gets into a very divisive view of things. It also means that we put into leadership increasingly. We're seeing this in government, we're seeing this in some corporate boardrooms. People not based upon their merit and not treating them with a focus of equality and proper justice, which means non-partiality, that we're actually giving special privilege to certain people now. We're actually doing reverse sort of racism, reverse prejudice, reverse partiality that's coming into things. And this is something, again, that we really are strongly disagree with. And what we need to focus on as a society and culture is equality before the law, proper justice, which means we treat people with non-partiality, and merit. We want to advance the very best people, the people that work the hardest, the people who have the gifts and abilities, so that we have the top managers and top investment decisions and in decisions in all areas of our society being made by people who are properly qualified, but not people to just sort of tick some box. And so this is something, again, that we're watching, because it's going to be dangerous to long-term economic growth if we continue down the road that we're going. And along with this cult of ESG, I just put this slide up here just to zero in on the one area of climate change, which is a real preoccupation that I'm sure, again, you're hearing about all of the time. And just to give you just a sense of some of the hypocrisy that we see out there. Take the US and China, compare these two countries just very quickly. They're obviously the two biggest economies, important economies, and how they're being treated in such different fashions when it comes to climate change and the sort of the global elites out there. First of all, as I point out on this slide, number one, the US has actually reduced their global emissions by more than any other country in the world on a percentage basis for the last 25 years. Second, China's emissions will continue to grow, albeit they're slowing in their growth, all the way out to 2030. Yes, 2030, 9 years from now. Third, China's greenhouse gas emissions in 2019 exceeded those of the entire developed world. They're massive. And then what I found quite interesting, if you on the fourth point there, if you look at cities and the pollution that's coming out of cities, if you're measuring that in terms of greenhouse gas emissions, you take the top 25 cities, 23 of those top 25 are actually Chinese cities. And the first US city, which is New York, is actually number 26. So the US doesn't even have any of their top cities in the top 25 in terms of greenhouse gas emissions. And when you take the top 75 cities in the world, which is a large number of cities, only 4 US cities are on that list. I point this out because you hear all this, all the pressure, the US is doing this, the US is doing that, terrible pollution out of a lot of the Western countries. But actually, a lot of the competitive, market-based, democratically based countries in the world are already well advanced and really moving along quickly in terms of being very prudent in terms of the environment and pollution levels. It's many of the developing countries and countries like China and India that are actually the serious problems, and yet the regulations in many cases do not apply to these people. And so it's really not an issue of climate change here, it's really an issue of wealth distribution and pressure that's being put on Western countries. And again, I just point that out as hypocrisy, and it's going to be very expensive if we continue down these roads without pushing back against some of these draconian regulations. Then let me talk quickly, and this is about COVID-19 and vaccinations and vaccine passports. And again, I know this is a very, very touchy subject. People have very strong opinions about this. I just want to throw out a couple of ideas for you to consider, and things that we are watching and keeping our eyes on. And again, we're just pointing out a number of things. Don't want you to take offense of this, some people, but I want us to be thinking objectively about what's happening here, and will this have long-term impacts in terms of our economy. So a couple things here. First of all, COVID-19 in our view has been overplayed. It's been, it's created too much fear in our society, and the lockdowns were draconian and the most costly and dangerous economic decision that's been made probably in history. Self-inflicted damage on our own economies. And I've mentioned that a number of times in our webcasts in the past. The second issue, though, is these vaccines. It's important that people realize that flu vaccines, these viruses, they're not going to solve the COVID-19 virus issue. That this is alive and well. It'll continue to mutate. There'll be continue to have variants, and the vaccines in the short run might lessen impact. They might help a little bit in the short run, but ultimately we have to work through this as not just a pandemic but an endemic. It will be in our country. It'll be amongst all our people, and so the focus on just vaccines without thinking about treatment, without thinking about bolstering our immune system, about other ways of dealing with this, protecting the most vulnerable people, I think is very naive, and it's again set us up for more problems. Because as we look at the most heavily vaccinated countries now that we've got the data, look at Israel, you look at Singapore, you look at Iceland, you look at other countries that have 80+% vaccination rates, it has not stopped the case counts. The case counts keep coming. Fortunately, death rates are down. Fortunately, there's more treatments. Fortunately, we know more about COVID-19 and the different variants. But it's important that people realize that we just can't lock things down. If we're going to go down that road every time case counts jump, we're going to completely destroy our economy and completely hurt much of the social fabric in our society. We just can't do that. And so this false hope that's been put out there by many of our politicians that you just vaccinate people and this will all disappear, I think is one that we need to be very concerned about. And when this doesn't occur, hopefully people will not be so frustrated, or governments will continue to abuse their power and shut down businesses and shut down churches and shut down all sorts of organizations where it really won't help. And hopefully we start to realize this after 18 months of these bad decisions that we've seen. The other point I would make on this that is important is that the concerns we have over these vaccines and vaccine passports. Let me just summarize in the last point here, three quick things. First of all, short-term adverse reactions and health risks of the vaccines. We're watching this. There actually are a lot of adverse reactions, believe it or not. And I know it doesn't get covered in the papers, but if you actually go to the CDC and you look at their website and you look at the VARs and you look at the different adverse reactions, there are actually a lot of adverse reactions, including deaths as a result of the vaccine. And so that immediately, when it's not being covered in the press, gets us to think, okay, let's just think about this objectively. What's going on here? The second issue that we're watching carefully, and we do not know what the answer is, but we're watching carefully as investors and the impact on our economy. Will there be longer-term impact on the human immune system of these mRNA vaccines, which are experimental? We don't know the answer. In fact, no one knows the answer. You talk to the person who actually came up with the mRNA vaccine, and that person actually warns people to be very careful about it. And so we've gone down this road, and we've just gone 100% into all of these vaccines, and yet they're still experimental. And if history tells us anything, when governments do something as big as this, and it hasn't been really thought out 100%, and they're still experimental, there could quite likely be bigger problems ahead. And so we are watching this carefully. We pray that there will not be. We pray that these things will not develop in a negative fashion, but we're watching it very carefully. The third issue, which I think is actually just as important, is that all of these vaccine passports and treating the vaccinated and unvaccinated in much different ways is leading to just increasing government control, and it's stripping personal freedoms and liberties away. And this is a big concern because we cannot run a strong free market economy, a democratic society without personal liberties and freedoms, including free speech and the ability to disagree with government. And so this is a big concern as we see government grab more and more power. This will eventually have a very strong negative impact on our economy, not to mention, again, on our freedoms in our society. Okay, now quickly, just the last point, market valuations. We've talked about this also. I don't have to tell you, the prices that we have to pay when we are buying stocks in the market are quite expensive. So we need to be very careful. We need to tell our investors, listen, going forward, returns are going to be tougher to come by. We're going to have to work harder and harder, and we have to be more attuned to valuations. This slide that's in front of you now, we call it the S&P 500 PE ratio versus the historical average since 1950, you can see that we're poking up at the pretty high levels there. It's well over, it's well over 30 odd times in terms of the price earnings ratio, and we're poking up to levels that were pretty close to the extreme valuations back in 1999 and 2000 with the tech crisis. So we want to be very careful about that. This slide here just gives you, and if you look at the bottom chart, if you will, if the bottom line there, you can see that in absolute terms what the price earnings ratio is, and it's running, as I say, about 33 times, I should say. And that's high. And so again, we just caution investors. And one of the reasons why it's high, let me make this clear, is that interest rates are very low. And so if interest rates stay really low, then valuations of stocks can stay quite high. The wild card here is where will interest rates go? And as we see inflation increase, as there's more pressure on rates to go up. If rates do go up a little bit, it will put a downward pressure on stock prices, and we need to be aware of that. We need to be careful, and we need to be as prudent as possible to manage that risk. Okay, sectors of focus. Let me just put these up quickly. These are sort of the 9 areas where we put a lot of our attention. 2 of those areas we're going to speak about in just a few moments. Jesse's going to speak about precious metals, the gold sector, and Andrew's going to speak about consumer staples. But we just put these up here so that you can see that there are certain areas of focus that we're zeroing in on as investors. Looking ahead, overall, we want to maintain large weightings in precious metals. We have quite a bit in precious metals, infrastructure, and technology, approximately 50% of your portfolio, especially the equity weightings. We're going to look at adding other sectors as opportunities emerge, and then reallocating overpriced securities to better priced securities. We're always looking at taking money off the table if it's on stocks that have done really well, and putting them into stocks that are trading at lower valuations, but also equally high in quality. And then keeping an eye and watch on the geopolitical risk and the medium to longer term impact of mass vaccinating a global population with an experimental vaccines. This is something that we are a little worried about. We watch and we're concerned about this. And history, again, as I mentioned earlier, tells us that these big experiments like this often don't work out well. And if that's the case, then we want to be really careful where we're investing and be able to react quickly if things start to deteriorate. Okay, performance summary. Just the last 2 slides here before I hand it over to Jesse to talk about the case for gold. As of the end of August 31st, this is our overall performance across our whole book of business, and that would be approximately 70% in equities and 30% in bonds. And you can see over the last 5 years, we've been compounding per year at about 9.86% a year. Over the last 10 years, 7.9% per year. And that would be, again, a mix of 65 to 70% equities and the rest being in bonds or short-term near cash. If you look at our pure equity performance, which gives you a good feel for what's happening in terms of the market there, you can see that over the last 5 years, again, we've done about 14.14% a year, and over the last 10 years, about 13.83, I should say, 13.85% over the last 10 years in terms of compounding. The area that's been toughest for us is really over the last year, because we didn't go down very much in 2020, and actually we held our own in very strong terms. Over the last year, some of the areas that got hammered the most where we weren't invested, those have come back quite a bit. And so we've been much more conservative or muted over the last year. But we love our positions, and our positions are very attractively valued. And if things do get a little messy in the market, we've got some of the most defensive growth stocks in anyone's portfolio. And so we're very happy with those positions. So chugging along very nicely, protecting capital when we need to protect it, and growing it over the long term. That's our focus. So let me turn it over to Jesse, who will give you an update in terms of the case for gold. And then Jesse will hand it over to Andrew after that. Thank you very much.
As mentioned, as part of our investment process, we like to think independently. Today, the average investor holds very little to no exposure to precious metals, and as Jonathan detailed at the beginning of this presentation, we think that's unfathomable given the monetary and fiscal backdrop. particularly in the last 18 months in the response to the COVID-19 pandemic. I've detailed 5 major points as to why gold is a key component to your portfolio, with the first one being on the first slide here. It's an excellent store of value. As you can see in the chart, all major currencies and their values have dropped precipitously relative to gold over the past 100 years. As governments have massive debt loads, they have no hope of repaying them, so the only way out is through debasement of the currency. In the same vein, there's financial repression. Real yields, which is the yield you receive after inflation, has dropped precipitously. In the chart there, you can see the 5-year TIPS, or Treasury Inflation Protected Securities, against the price of gold. And as yields go negative, gold price goes up. Because real yields are so low, and the yield on cash, money market funds, or fixed income securities is so low, gold provides an excellent alternative for a store of value. Secondly, there's portfolio diversification. Gold has provided an excellent buffer to bouts of equity market volatility, as you can see in the various instances where the market has experienced a large drawdown and gold has performed quite well. Thirdly, gold is tangible and portable. It cannot be tracked or traced. It provides excellent anonymity, and it is easily convertible to cash. It is globally accepted, and there's no counterparty risk. Currency actually has the counterparty of the government, and it is a liability. Gold has no such counterparty, and it cannot go bankrupt. Fourthly, it provides superior absolute and risk-adjusted returns. Many investors and fund managers like to own commodities as a hedge to inflation, and gold has proven an excellent hedge to inflation, outperforming such commodities over various time horizons on both an absolute and risk-adjusted return. And lastly, there's increasing demand. Central banks themselves own gold as part of their reserves, and there has been strong investor flows in the past couple years, particularly in light of the increasing debt burdens and in response to COVID-19. Across client portfolios, we like to own 2 of major segments within the precious metal space. Our preference is towards royalty and streamers. While they have no operating exposure to the mines, they have great stability and great compounding ability as they take their cash flows and reinvest it into new streams and deals. And we also have miners themselves, which provide great leverage to the price of gold. Going forward, given the uncertainty, both monetarily and fiscally, gold will be a key component of your investor portfolios.
Capital allocation can play a significant role in creating value in a company. It involves determining the best use of financial resources to maximize returns. As active portfolio managers, we like company management teams that carry an active portfolio management mindset or strategy to their overall business. Companies that focus on active portfolio management of their brands and products are not complacent or idle, but continuously reevaluating their portfolio products, staying at the forefront of long-term consumer trends, accelerating product innovation, making strategic divestments of laggard businesses, and adding new or doubling down on existing high-growth businesses that generate higher shareholder returns. One company that has both embraced and benefited from active portfolio management is Nestle. With over 150 years of history, Nestle has become the world's largest food and beverage company. It is a major global company with its products in over 180 countries. Nestle's products are quite ubiquitous. Its products can be found in approximately 97% of U.S. households. You may be familiar with many of its brands, such as Purina Pet Care, Nescafé, Lean Cuisine, Haagen-Dazs, San Pellegrino, Cheerios, Kit Kat, and Nestle Pure Life Water. It has over 2,000 brands in its portfolio, of which over 30 of its brands generate over $1 billion in annual revenue. Many of its products are quite dominant in its categories. In particular, Nestle is the world's largest coffee producer, with brands such as Nespresso and Nescafe in products in over 180 countries. Over the past number of years, Nestle has made a series of decisions to transform its portfolio of brands. In 2017, Mark Schneider became the new CEO of Nestle. The management team took several steps to transform its portfolio in areas with higher long-term growth trends, such as coffee, pet care, health and nutrition, frozen meals, and bottled water. Since 2017, Nestle has closed or announced over 75 transactions, and that includes a combination of acquisitions and dispositions. So, for example, Nestle doubled down on the coffee category, which is the company's largest and highest growth category. In one of its most lucrative deals, Nestle signed an agreement with Starbucks to have perpetual rights to market Starbucks products outside of Starbucks coffee shops. And these products include packaged coffee and tea brands and the K-Cup pods. This partnership has paid off very well for Nestle. After just over a year signing the deal, Nestle was able to leverage its strong global relationships across grocery and food services to help expand Starbucks' international presence and launch its products into 50 international markets. In last year, 2020, Nestle sales of Starbucks products was $2.7 billion. Nestle has also focused its investments towards becoming a major health and nutrition company. For instance, in 2017, Nestle acquired Atrium Innovations, which is a nutritional supplement company, with brands such as Garden of Life, Pure Encapsulation, and Genestra. It later acquired Persona, which is a personalized vitamin business that creates customized supplies according to a consumer's history, lifestyle, and needs. Nestle also acquired Bountiful Company, which is a pure play nutrition and supplement company that has brands such as Nature's Bounty, Osteo Bioflex, Puritan's Pride, and Pure Protein. Nestle has also focused on dietary management and therapeutics of certain health conditions. For instance, Nestle acquired IM Health Sciences, which produces dietary products that are used to manage digestive problems such as irritable bowel syndrome. Nestle has not only been active in adding to its portfolio, but it's also been divesting assets that it believes no longer fits in its portfolio. This decision to divest a business can be difficult as management weighs whether it's better to outright sell a business rather than continuing to invest capital to improve a lagging performance business. For instance, Nestle divested its U.S. confectionery business, which includes O. Henry, Butterfinger, Baby Ruth, and Crunch. The decision to make this divestment came as a result of its lagging performance relative to its competitors. And instead, Nestle decided to focus on growing its international confectionery business, such as Kit Kat brand, which has become the #1 selling chocolate bar across the world by market share. Now, turning to our investment thesis, along with its prudent capital allocation, active portfolio management, we also like Nestle because it is a global leader with significantly dominant brands and it's a significant economies of scale. Nestle has leveraged a strong brand reputation and established long-standing relationships with suppliers and retailers. Nestle has also developed significant global manufacturing and distribution footprint that enables the company to rapidly launch and expand its own new products across multiple geographies. This has also been a reason for its success for its acquisitions. Nestle has made prudent acquisitions of growing, leading brands without adding on significant amount of debt, unlike its competitors who has made large acquisitions but has added on significant amount of debt. Now, this hampers a company's ability to make investments in its product innovations and growing its brand of products. And Nestle, conversely, has been able to balance both. It's been able to add to its portfolio through acquisitions, but also making strategic and just wise investments to its R&D. Nestle focuses also on improving operational efficiency. So it doesn't only focus on growing the top line revenue, but also making operational efficiency changes, reducing costs, and making things more lean. And this ultimately helps translate to better operating margins. So for example, over the past 4 years, Nestle has saved over $2.8 billion through cost reduction initiatives, such as reducing head office costs, reducing fixed factory overhead, and improving production line efficiencies and standardizing its raw material specifications. These savings can then be redeployed in product innovation and growing initiatives. Nestle has an extensive R&D program. Over the past 5 years, Nestle has invested over $1.5 billion each year in R&D. And Nestle also complements its R&D initiatives by drawing expertise from its established relationships with leading academic institutions. So PhD and master's students can apply to Nestle's research and development program and apply the research into state-of-the-art R&D facilities. Nestle also launched an R&D accelerator program to expedite the development of new product innovations. So the program enables entrepreneurial startups and students from various academic backgrounds to work with Nestle's R&D employees to experiment and develop new product ideas. Since launching the program in 2019, there have been close to 80 products that have been developed and tested in 18 countries. Nestle is also a dividend aristocrat, has a strong balance sheet, and has been able to generate consistent cash flow, which has enabled the company to increase its dividend for 25 consecutive years. In fact, this year, 2021, will mark the 26th year that the company has increased its dividend. Nestle has been a staple for generating income for our client portfolios over the past number of years. And then lastly, the disciplined capital allocation and portfolio management and its capital cost reduction initiatives has led to strong performance over the past number of years. So for example, Nestle's return on invested capital has increased from 10.43% in 2016 to 14.75% in 2020. Operating margins have expanded 110 basis points over the past 5 years, which is a testament to its cost reduction initiatives. And then lastly, its organic revenue in the first half of this year was 8.1% compared to 2.3% in the first half mark of 2017. And this just shows that Nestle has been able to generate great returns from its product innovations. It's also been able to take its acquisitions and deploy into new markets and grow that organic revenue. And so for many of these reasons that I've mentioned, we continue to believe that Nestle is a long-term investment in our portfolio, making good acquisitions, capital allocation decisions, and we believe that Nestle will continue to grow its dividend and generate good income for client portfolios and capital returns as well. So with that said, I'm now going to turn to our presentation over to Jonathan for closing remarks.
Great. Thank you very much, both Jesse and Andrew. Those are wonderful presentations, and hopefully, again, those give you a really good perspective in terms of why we're invested in the gold space and some of the companies that we own in that space, along with Nestle, which would be one of the preeminent global consumer staples businesses and very much aligned with some of the other consumer staple companies that we own in the various portfolios. So appreciate the, having the opportunity to speak with each of you today, and just to let you know that our next webcast is scheduled for December the 9th, and we'll be releasing that around the December 9th timeframe. So I hope that you continue to have a wonderful end of the summer, and you also are able to look forward to a wonderful fall season. Thank you very much for your support. Look forward to speaking to you in 3 months. Bye now.